Hey everyone, we're here for our next session, which is on Tether's history, where we are today, and learnings for other asset-backed stablecoins. Would you guys mind introducing yourselves?
Yeah, I'll start. My name's Stephen McClurg. I'll be moderating the panel, but mostly sitting back and listening to Phil and Jake talk. I'm the co-founder and CEO of Basket, which is a stablecoin company focused on building a new kind of stablecoin that generates yield, that's wrapped in a security that has access to several different markets.
I'm Jake Chervinsky. I'm general counsel for Compound Labs. We are an open source software development company working in the crypto space. We originally developed the Compound protocol on the Ethereum blockchain, which is an interest rate market for digital assets. We also just launched a new project that we're working on this week called Gateway, which actually produces a sort of stablecoin-like asset called Cash that tracks the value of the dollar. So working on stablecoins in that sense. I'm really glad to be here to chat with you guys.
I'm Phil Potter. I guess currently I'm the CEO of Potter Ventures, doing a lot of sort of early stage investment in crypto companies, but I'm formerly the Chief Strategy Officer of Bitfinex, as well as the Chief Strategy Officer of Tether. I'm the co-founder of Tether and the co-inventor of the stablecoin, I guess. So one way to describe it.
Great. Well, starting off, first of all, thanks Phil and Jake for joining us today. And I'd like to start off by just asking, Phil to start off by talking about the history of the stablecoin, and then as you go, Jake, please step in and talk about where it's going.
Sure. Thanks, Steve. So where to start? The idea for a stablecoin kind of emerged back in 2013, really around the idea that it was very unclear how governments were going to regulate crypto exchanges, right? So you had this situation where crypto was exploding in popularity, at least on a relative basis back then, right? I mean, Bitcoin started the year at, I don't know what it was, $25, $50. And then, of course, in the course of that year, went up to $1,000 plus. And certainly there was the Silk Road takedown that summer or the spring. So a lot of things were happening that were gaining the attention of regulators. And what it became clear is that the regulators didn't know what to do, or didn't even understand what Bitcoin was, and then didn't really understand what to do about crypto exchanges. And banks, frankly, didn't want to have anything to do with crypto exchanges. So there was kind of ultimately kind of two problems here. There was a problem of, like, for a crypto exchange was accessing fiat, as well as potential regulation around running an exchange, right? So, whatever protections a government would want to put into place for consumers or what have you. So the idea was, it's like, well, what if we were able to separate the compliance problem into two pieces? And one was, and so to me, it seemed like, it seemed pretty obvious to me at the time, was since it appeared at the time, at least, that Cryptsy and people like Cryptsy or MintPal or others that were only crypto in and out seemed to be getting a free ride at the time. Like, we were like, oh, there's no real regulation there. The government doesn't really recognize this as something it needs to regulate. I'm like, oh, okay, well, and then what if we had, what if dollars were in fact a crypto? What if we had a crypto dollar? I called it a crypto dollar at the time. And then we had a system where we could, tokenize dollars on the blockchain. And my tagline at the time was, well, we can create PayPal on the blockchain. And that was really all it is. It's like, how do I create what looks like PayPal, but instead of using a centralized database, well, why don't I piggyback this on top of the public blockchain? And that was really the beginning of it. And we found other like-minded people in the industry. and partnered, and there was the search for the right protocol to use back then, because what colored coins, it was Counterparty, it was Mastercoin at the time, now Omni. Ultimately, we settled on Omni because my co-creator Craig Sellers was running that project, and it seemed like the right way to go. But for the longest time, I mean, created it. It's like you think build it and they will come, but no one came. There was no real interest in Tether for quite a while because Bitfinex was the only network for Tether. I mean, there were a few other really small players that were integrating Tether at the behest of, because other people who were shareholders in this process had investments in other small companies, and they would try to bring them into the fold. But the real moment, I think the real moment for the market to realize that stablecoins were useful, really centered around, I think it was really around the time that the hard fork occurred on Ethereum after the DAO hack. So Ethereum Classic emerged as a thing, kind of quite unexpectedly, and Poloniex, which was basically a nobody exchange at the time, was the first out with supporting ETC. And so all of a sudden, all this liquidity rushed over there, and there was so much trading volume in this. But they were the only other exchange that integrated Tether early on. Why not? They didn't have a bank account. And again, I think that was a relationship that Craig had over there, got them to do the integration to OmniCore. Great. Now all of a sudden there was and then we released, Bitfinex put Ethereum Classic out there for our customers, and now there was this arbitrage channel that existed between Poloniex and Bitfinex that never existed before, that could happen in blockchain times versus bank settlement times, which is orders of magnitude different. And that's where it started. And then we said, well, what other assets does Polo have that we don't have yet? And then we added XRP, and then we added, and then all of a sudden this started happening, and then other exchanges, or it was Kraken or Bittrex or this, exchanges around the world, got on board, and I think the rest is kind of history. That's the point which it came into the sort of the zeitgeist of crypto tools, which in turn enable platforms like Compound to exist and have relative, DeFi doesn't exist without stable coins, really. So that's kind of the early history there.
Yeah, it's super fascinating to hear the history, and also that it took so long sort of for it to catch on, because to me, the value of stablecoins is just obvious, right? I mean, what Bitcoin does for the transfer of value, right? Making it borderless, almost instant, almost free, right? This is such a categorical improvement on the traditional financial system that, everyone who gets involved, I think, in Bitcoin from the start sort of understands what a huge improvement it is. But, I think it's also obvious that a lot of people really just want to transact in US dollars, like it or not, right? Bitcoin is not the global reserve currency. Maybe someday it will be, but we're pretty far from that. But bringing the same benefits of a public blockchain to the transfer and settlement of dollars is just a huge deal. And I think, to me, that's pretty obvious. And the market has shown how much demand there is for that. I think, maybe it was in 2017 that, all of a sudden stablecoins really became, as you said, a huge deal. I guess just to throw in a couple thoughts about Tether and what's happened recently, which I think has been in the news a lot. Tether has become somewhat controversial. And I think some of that stems from valid concerns that were alleged by the New York Attorney General that there was an issue where Tether was described as being one-to-one backed, every US dollar Tether backed by $1 US in a bank account. And there was a period of time where that may not have been true, or so the New York Attorney General alleges, and launched an investigation into. And I'll admit, there was a period of time where I was really skeptical about this, right? Because there's an element of Bitcoin, one of the sort of most amazing and innovative elements of it, which is you do not have to trust a third party for the value of the Bitcoin that you hold in your wallet. Whereas for a stable coin that is issued by a centralized third party like Tether, you are in a sense trusting Tether that your USDT is actually backed by a dollar that you can redeem at some point, right? So there is that element of trust. And I think those allegations that perhaps that trust had been violated were serious and worth looking into. The thing is, this spun out into this wild, crazy conspiracy theory that a bunch of people who I think just hate Bitcoin decided to make up in their own minds. So, what started as sort of a legitimate inquiry became theories that Bitcoin only had value because Tether was printing new USDT without any capital inflows of dollars, or that Tether had no reserves at all. And the whole thing was actually a sham, and there really weren't any bank accounts holding any dollars at all.
Car wash tokens.
There you go. And I mean, I think there was never any evidence to support any of that. And what happened recently, which I think is, first of all, in a way, a strong vindication for Tether itself, but also just a great signal in general for the crypto markets, is the settlement with the New York Attorney General, in which Tether paid, I think it was $18.5 million, and made no admissions of wrongdoing. And, the Tether truthers sort of very quickly moved on to a new argument, right? For starters, it was the Attorney General.
Those goalposts are always moving. Yeah.
Oh, just really quickly, right? It was the Attorney General is going to take down this massive fraud. And then the settlement comes out. And now the story is, no, the Attorney General was never going to take down this massive fraud. Actually, it's some other agency that's going to do that. And I guess what I'll tell you is, and then we can sort of move on to talking about, where we are today and lessons from what's going to happen next. But, my background before getting into crypto was in government enforcement defense. So, once upon a time, I would have been working, for a company like Tether, on this type of investigation and working out that kind of settlement with a government agency like the Attorney General in New York. And I think what folks need to understand about this is, when there is a thorough investigation like this was, and let's give credit to the NYAG, right? When they investigate something like this, they don't do it halfway. They do comprehensive investigations. Oh, yeah. And I think millions of pages of documents were turned over, in this investigation over the course of years. If there is a finding, and this is somewhat speculation, but this is just sort of how this stuff works. If there are findings of serious fraud, you don't see a settlement like this, right? Instead, what you see is something more like what was alleged in the case of BitMEX, where on the same day, you see a whole lot of allegations come down in a very serious fashion from all of the agencies that have been involved in the investigation. That's not to cast aspersions on BitMEX, right? They're innocent until proven guilty, just like everyone else. But the settlement speaks volumes, I think, about the lack of evidence of these supposed frauds. And I also think, sort of to move on to what's coming next, one of the great things to come out of the settlement is that Tether will be making more disclosures, right? They will be required to make more disclosures about what the assets are that are backing Tether. And in truth, that's what really matters, right? Is making sure that the market has information about the value of the assets that they're able to purchase and sell. So I guess I'm sort of curious, Phil, from your perspective, this whole issue of disclosures and attestations versus audits, and sort of how you address this issue of trusting a third party issuing a stablecoin. I mean, what are your thoughts about how we move forward on that?
Right. So I would just preface my comments by saying that I left Tether in early 2018. So the crux of what NYAG alleged, and all post-dated me by quite some time. But that said, I was just reading yet another article kind of recapitulating this settlement in the FT a couple days ago. And one thing that always hits me, it kills me every time, and I want to be very clear about this, is that in the article they're like, and by the way, Tether still refuses to be audited. And this always seems to be a refrain that we hear constantly from the sort of the truther camp, if you want to call it that, or just people, the doubters, right? The reality is that it's certainly when I was there, and I'm almost certain this continues to this day, Tether would have no problem, has no problem with being audited, just no one wants to do it. And if you have been in and around that industry, you would know that, the client acceptance process at an auditing firm is rigorous. For a lot of these firms, reputational risk is everything. I mean, when we saw the Enron, Arthur Andersen thing, go down, like ever since then, which was a long time ago at this point, these auditing firms have been very, very careful about the types of clients they bring on. And for them, to earn a few $100,000 or maybe $1 million in fees was just not worth it, given what they perceived was the incalculable sort of fat tail risk on what if they pull the wool over our eyes or somehow, and we are somehow implicated in some grand fraud. So at the end of the day, Tether didn't fire its auditor Friedman. They fired Tether, and never gave a real reason. Tether tried to find anyone that would be willing to audit them. The best that they could do was go to Free Sullivan and Sporkin. They said, well, let's go talk to Louis Freeh's law firm in Washington. I mean, who's more reputable than a former FBI director? But the market wasn't satisfied with that attestation either. Oh, they're not accountants. Well, come on. I mean, yeah, they're reputable lawyers and ex-federal judges and heads of the of law enforcement agencies. Whatever the case may be, no stablecoin in the world, as far as I know, is subject to any type of like full audit. And that's a misleading term to begin with. What they get is attestations, and an attestation is really nothing more than an accounting firm saying, we've seen the records. We maybe double checked directly with the bank. Yes, monies are there. This appears to be the number of outstanding tokens according to the blockchain. Okay. Now, we don't see any other liabilities on the books as of today, but we can't say for sure. That's all that any stable coin has right now.
I'm just not to cut you off. I'm just curious, what is the difference between that and an audit? Like, what would an audit tell you that the attestation doesn't tell you?
Well, I mean, I think that there would be, at the end of the day, it's really in order for a accounting firm to say, yes, these are the assets and these are the liabilities, they would have to look at the complete history of all the assets and liabilities. So they would essentially have to go back essentially to, the last time the books were audited, and then go for that but since it's never really been properly audited, you kind of in some ways would have to go back to transaction number one and track everything and make sure that, and it's, that's just complicated. And frankly, the assurance industry is just either not ready to do that type of thing, or they don't really have an interest in doing it. But that's what it would be. You'd have to build up the entire history to make sure there was no hidden liabilities, or like, oh, the assets that are here, this is actually a loan, or this is, so right. That's the essential difference.
Yeah. And I mean, I guess from my perspective, I mean, you're right. No one has an audit who is a stablecoin issuer, right? And I think the stablecoins that, at least in the US, are viewed as being the most reputable, which I would say is probably USDC. They also don't do audits. They do attestations, right? So they'll every month publish an attestation saying, here's how many USDC are in circulation. Here's how many dollars are in this, in this account. And that's more or less what it is. I do think going forward, look, stablecoins have really exploded just in the last year, right? I think volumes of stablecoins are, in the tens of billions of dollars now and growing very rapidly. And we also saw the OCC, Brian Brooks, before he stepped down, his OCC issued an interpretive letter saying basically this is valid settlement infrastructure for financial institutions, right? I mean, whether that interpretation will stand up under
survive, right?
I think, yeah, is yet to be seen. But I think the point is, right, stablecoins have a really bright future. I think that what we will have to figure out is, from a regulatory perspective, what assurances are sufficient in order for financial institutions and other people to sort of comfortably and confidently use these assets. I would say in my mind, an attestation shouldn't be sufficient long-term, right? I think it's as good as anyone's been able to do so far. But to me, the benefits of that audit, right, where you say, not only are these dollars in this account, but also the dollars are unencumbered, right? They're not from a loan that are getting sent somewhere else. Or also the dollars are not at a high risk of being involved in money laundering or terrorist financing, and therefore will be seized by some government authority or something like that. I think all of that is really important. And I just wonder how we're going to get there. It's almost a chicken and egg problem, right? You need to convince the Deloitte's, KPMG's, Ernst & Young's, et cetera, of the world to do these types of audits before you could pass some new rulemaking or legislation requiring those audits. Because if you require them right now, well, that's the end of the stablecoin industry. And I think nobody wants that. So I think we're going to have to sort of figure out how to blaze the trail. Maybe these auditors will be more interested to get involved now that stablecoins are blowing up.
Right. So I think that one of the, I think you're 100% right, Jake. I mean, I think that one of the issues is going to be that even if you look at stablecoins that have been specifically approved by the New York Department of Financial Services, say Paxos and Gemini, for example, these are two products that operate exactly the same way as Tether. There's a lot of KYC and AML compliance happening on the on-ramp and off-ramp. And despite what anyone will say about Tether, I can tell you, at least when I was there, that stuff was always, there was always heavy KYC and AML for any fiat transactions coming in and out. Period. End of story. And it's always been that way at Tether and at Bitfinex, and continues to be to this day, to my knowledge. Now, that said, once they're issued and they're in the wild, even the NYDFS acknowledges that they can pass around without KYC or AML controls on a public blockchain, and that's what's happening today. I think that my guess is that will change in the future. Hopefully, it will change, and that's the reason why I think auditors would have a hard time, being able to count all of those liabilities correctly, because they don't know who's holding those things, and they don't know, for example, if Kim Jong-un is sitting on a bunch of Tether, or USDC or what have you, because he would be a sanctioned person, for example, and that would, those are the types of unknowns that the big four accounting firms are they're gonna just say, we're just not gonna do that right now.
Yeah.
So I think that down the road, I think that it's coming. I mean, I think that we need to be aware of the fact that issued assets, whether it be stablecoins, whether it be security tokens or other types of securitized interests, will eventually have to interface with some type of identity solution. Now, whether that's a blinded solution that just all it's saying that I don't need to know who you are, just that I'm allowed to transact with you. I think it's going to be something that looks like that, but I don't know. I feel like that's the next big thing that I think the industry is going to have to tackle if we're going to look for broader blockchain utility in issued assets.
Yeah, I tend to agree. I guess actually sort of two separate issues here in my mind. One is, in terms of audits, right? If the question is, can we give confidence to the market and to regulators that these digital assets are fully backed by a reserve held in a bank account? I actually wonder if auditors even need to bother looking at who's holding the digital asset. Right? To me, all they should need to do is look at the dollars in the bank account and trace who sent the dollars in and sort of what other encumbrances there might be on those dollars, right? To figure out if they're...
I agree from a technical perspective, you're 100% right. I just think that there's the unknown that goes into the category of reputational risk. That
right.
It's like, we don't need to know who's holding these things, I guess, but sure would suck if there was if we did a full audit of these guys and then there was some huge government case and all these tokens got frozen and there's and there's some kind of child pornography thing going on, and or human trafficking and paid for in USDC or whatever. Like, that would be bad news,
Yeah.
and no auditor would get off. They would end up spending millions, way more than they collected in fees, just dealing with their own, defending their, doing their own, KYA, cover your ass, right?
Right. Right. And I can tell you from personal experience, having worked with these folks on anti-corruption and anti-money laundering investigations, I don't think you can find a more risk-averse group of folks than the auditors at these, especially at the big four firms.
100%.
I guess let me throw in just on the other side here the thoughts from the DeFi perspective, because I think DeFi addresses sort of both of these points in different directions. I think on the audit side, in terms of, can we be sure that these digital assets representing the value of $1 are fully backed? On that question, DeFi sort of natively solves that issue, right? The beauty of DeFi is that the collateral isn't in a bank account where you're not really sure what's in the account. There's no real-time auditing. You don't really know what other legal agreements might be around those assets, right? The collateral is locked in a smart contract on the blockchain that can be audited at any time and is visible to anyone, right? There is no question about something like DAI being fully backed by a basket of assets in the MCD smart contract. Yeah. On the other side, though, right, I think there's more concerns about the second point that you, or the point that you've raised about who holds these assets. And I think one benefit that the centralized issuers like Tether have is, if there are law enforcement concerns, right? Kim Jong-un is holding US dollar Tether. Well, guess what? Tether can freeze those assets. And that happens.
Anytime.
They have done that. Whereas something like DAI.
So have other stablecoins, but something like DAI.
Right, yes. Right. USDC, they've frozen addresses as well. Something like DAI, for better or worse, and I think in my view, for both better and also for worse, like most technology, you can't do that. And so there is a question, I think, whether regulators will, in the end, treat centralized stablecoins that are not crypto native as being somehow more acceptable than crypto native solutions like DAI or Compound Cash, which is the new project that Compound launched.
Yeah, I mean, these are weighty questions for the industry going forward. I mean, it's and my sense of it is that stablecoins get more traction, and crypto in general captures more and more of the investing public's imagination, that regulators are going to focus on this, and not just in the United States, but EU, other places. I mean, it does bring up questions in my mind as to how would a CBDC work at the end of the day, keeping in mind these types of concerns that we're at least voicing right now. I mean, how would a CBDC work? What technology would they employ? What blockchain would they use? Would it be even a blockchain? I mean, or would it be just some kind of like regional? Like would it be like something like Liquid, where it's like a pegged, some type of federated peg, that's happening with the 12 regional, Federal Reserve banks? I don't know, but there's clearly, as we've seen with the price of gas on Ethereum. I mean, Ethereum's not ready to handle those types of loads, nor would an Ethereum clone, or fork necessarily. I don't know what technology is, and how do I get a wallet? I mean, is it a wallet that's associated with a tax ID? How do they blind that? I don't know. I have a lot of open questions as to how this would even happen.
I agree. I think it's unknown. I think it's hard to imagine a CBDC being on a public blockchain. The point of a public blockchain, right? The reason that Ethereum is expensive to transact on is that it is permissionless and yet secure, right? That's why we are willing to spend these fees, is so that we can have censorship resistant, self-custodial, secure financial infrastructure. When you have a CBDC, the incentives, the priorities that central banks have don't really match up in that way. And to your earlier point about sort of identifying the participants in these systems, right? Who is holding these stablecoins? What a lot of regulators have suggested is stablecoin systems that do not allow for identifying every single participant at every single point are unacceptable. So, the president's working group on financial markets in January put out this statement with some preliminary thoughts about stablecoins. That's more or less what they said. There was a statement from, I think it was the BIS last year, where they said anonymity in global stablecoin arrangements is, not plausible, or they use some language like that. And so I do think that if you're going to create a CBDC in which you want to impose those levels of restrictions, right? You can't just create a wallet by picking any, random private key from a private key generator, or you're not even really creating that. You're just sort of picking the private key that no one else is going to be able to get. If you sort of don't want that, then you're not going to use a public blockchain. And so I do think we're in this point now, especially in the US. I don't know, sort of, where Europe is on this, as well as I understand the US, but the question is, how will we compete with what China is doing with the DCEP project, right? They have a very aggressive strategy around a digital yuan, which is 100% centralized. And the question is, does the Fed create its own sort of like proprietary competitor, or do they partner with private industry, right? They work with someone like Tether, or with USDC, or with these other private solutions within DeFi, to say this is a better way to sort of spread the US dollar far and wide than trying to build a proprietary CBDC blockchain or something like that.
So I think that when you look at the popularity of Tether, the huge use case for Tether is in Asian dollar settlements. And why is that? Well, it turns out that if you, and by the way, Tether, I mean, a lot of people don't really realize this, but a huge use case for Tether is not crypto related. I mean, people are using Tether in Asia for trade finance, for optimizing supply chains, for posting collateral for any number of transactions, right? You can post collateral kind of instantaneously. And when from Taiwan to Singapore, those places are really close. But if you want to send dollars, because everybody wants to settle in dollars, even though there's Singapore dollars and Taiwan dollars, but U.S. dollars is what people prefer to settle in. It takes 2 days because you have to bounce. The time zones are so different than the U.S. and you have to bounce off of a U.S. correspondent bank during U.S. banking hours. And God forbid you need to do something over a long holiday weekend. I mean, so Tether is just basically, in those cases, have just increased the sort of the velocity of money to really, frankly, I think support the economic output of that region. In a small way today, but in a growing way every day in the future. So there's a strong use case for being able to do kind of near instantaneous dollar settlements 24/7, 365. And that's going to be the challenge, I think, for any CDBC, or let's say the Fed, for example. They want to do that. Well, it needs to have that capacity, and it needs to be able to settle somehow on a pseudo decentralized basis, i.e., maybe it's the 12 regional, Federal Reserve, maybe it's the correspondent banks become nodes on this federated peg. Maybe they're using some type of consensus mechanism, not unlike, say, like I mentioned, Liquid before, or something like that, where you have a bunch of trusted nodes kind of doing some type of ring signature scheme or something like that. That could be very high throughput and achieve like Visa level transaction throughput. And I don't know, maybe you want a wallet, you need a tax ID, and you can have lots of sub wallets under that tax ID, but I think that's going to be something, I don't know. I'm very interested, and I'm trying to insert myself into that conversation with people in the government. But it's going to take a while to evolve.
Yeah. Is that Sinju? I think we might be running out of time here.
Yes, we're exactly at time right now. Thank you guys so much for this discussion. It was fantastic.
All right.
Yeah,
My pleasure.
awesome. Thanks. This was great.
All right, take care.
Have a good one.
Bye.
Bye.